Well, hi, Joshua. Welcome to our podcast.
Happy to be here.
Now, over the next little while, we're going to be running regular podcasts on various financial topics. I think, loosely speaking, we'll be talking about various financial planning topics. We'll be talking about tips for the under 40s group around investment planning and financial planning. We'll get into major investment themes that may be emerging at the date that we're having the podcast. So it'll be a bit of a potpourri of ideas. I'm really excited about doing the podcast with you. But before we get into it, I know you've got a few questions for me today. Maybe give us a bit of your background. What are you up to right now?
Yeah, so currently still at the U of M. I'm doing a Bachelor of Commerce, and my major is finance and marketing. So the rationale for finance would probably be relating to the financial services industry, and it kind of relates to that best, right? And out of all the majors, finance was really the only one that piqued my interest. And I'm doing a double major, so I'm also majoring in marketing. And also the reason for that is because I needed 3 business electives, and I needed 3 marketing courses to get a double major. So I just took marketing courses. And so, I got 3 terms left. And then we're off. Get some designations and then go from there.
Perfect. So Joshua works full-time in the summers with us and part-time during the school term. We're really excited to have him part of our team, and he's become an indispensable part of our team. So again, it's been great to have you involved. So I know that you've got a few questions for me, so maybe you just lead in and we'll go through our agenda. I think the first topic area, I believe, is in the area of estate planning. Is that correct?
Yeah. So estate planning is kind of part 1 of this podcast, relating to kind of why it's important, and I guess kind of asking the question of why, if it's important, why do more people kind of avoid it or not see a need there. I guess relating to that also is there's a study that we were looking at earlier, and it's kind of giving some statistics on different generations and how they viewed estate planning, and whether or not they update their wills, whether or not they even have one, right? Yeah. And so a common theme when we were looking at that was why people don't want any sort of estate planning. Why do they not see a necessity there? And is it true? And is there no need when life is going well? Kind of idea there, yeah.
Okay. So I'm not surprised when you look at the data. I'm not surprised by the fact that actually a high percentage of people don't have a will or don't have an up-to-date will. And I think there's a lot of factors that lead to that. I think one is just a subconscious factor. I think subconsciously people are reluctant to engage in discussions about their own demise or death. Yeah. And so they just sort of put it off. I think that's pervasive. I think it's there, and people have to fight through that kind of subconscious pushback from this topic. I think the other reason is we're just busy. We get it's the tyranny of the urgent. We like to focus on investment planning and growing our savings and what our money can do for us. But when you think about the estate plan, it's not so much about us, it's more about the people we leave behind. I think for some people that's not quite as exciting as a topic. But it's really, really important. And I'll give you one main reason that you want to engage in the estate planning discussions, and that relates to the fact that we all work hard for our money. And as you begin to save money and accumulate financial assets and real assets like real estate, if you die without a will, often referred to as intestate, then you don't have a representative to really handle the estate distribution. And so it becomes expensive, time-consuming. Probably your heirs will spit on your grave because you've made things very, very difficult for them. So if you're worried about preserving your capital you've worked hard to accumulate and pass it on to the next generation or to a spouse or partner, you want to make sure you've got an up-to-date will in place.
Yeah, so with the up-to-date wills, is that just beneficiary stuff, or what are some of the important parts of things that they could look at?
Yeah, so you bring up a really good question. So one of the things that you want to always understand when it comes to estate planning is you have this broad topic of estate planning, but then you've got the different pieces of your estate. So in Canada, as an example, when it comes to estate planning, we have something called the operation of law, which I'll come to in a second, and then your will. Through the operation of law, you don't have to necessarily have a will. So the operation of law is having a beneficiary designation on insurance policies, an RSP account or a RIF account or a TFSA account. So if I die prematurely, if I have a beneficiary designation on those assets, all that is required is a death certificate, and that asset can be given or paid out to that beneficiary. So it's very easy to deal with. So if you have a partner or beneficiaries, then administratively it's simple. Where it gets complicated is if you don't have a beneficiary attached to those assets, or for those assets that are just in your name. So if you die without a will, then it becomes complicated as to how you direct and deal with those assets. Okay, so for the most part, the estate planning discussion is all-encompassing, where you're looking at which assets do I have a beneficiary assigned to it, which assets might be just in my name. My will speak to that in terms of how it gets distributed. So it should be a holistic discussion, and not all assets get treated exactly the same based on what your priorities are.
Yeah, and I think one statistic that kind of speaks to this and kind of the problems that can arise when you wait, right? So 104 Americans without a will don't ever plan on getting one. More than 40% say they plan on waiting until a medical diagnosis. So how could a medical diagnosis affect kind of that stuff as well?
Yeah, and so we're using U.S. data, but our sense is that the numbers aren't a lot different in Canada, and that's been my experience. I think that it gets back to that subconscious aspect. We put off this important area because it makes us feel uncomfortable. And we think that somehow life will evolve to make it obvious that, oh, I might die, I have a health issue, so now I'll deal with my estate plan. But of course, we all know that life doesn't work that way. Life throws curveballs at us, and we have to respond, or our families have to respond to those curveballs. So you don't want to wait until an event happens for you to attend to this very important area. So it's very curious that people will use an event like their health to be the trigger point. I understand why, but I mean, none of us are giving guarantees about how long we're going to live, and so you just want to attend to this area, fight through the inertia of your concerns, your anxieties about dealing with a tough topic, which is death and dying, and just get it done, because your beneficiaries will benefit very significantly for the fact that you've attended to that topic.
Yeah, and lastly, I guess, like the disconnect between how people view estate planning and their actions to do something about it. So the statistic kind of relates to the disconnect, right? We say we want to do something, we think something is important, and do we actually do anything about it? I mean, in my own life, I when I was younger, when I hit 18, I wanted to set up a TFSA, and it was always something that was on my mind. I was like, I want to start contributing to it, and it took many, many years. I thought it was a super important thing. I mean, you'd always talk about the importance of it, and I just would put it off, right? And because of that, my savings took a while to start getting going, right? So same thing with estate planning, where same study here, more than 2 out of 3 Americans believe you should have a will by age 55 or sooner, but less than half of those actually have one. So obviously that relates to pretty much every area of life, but I think it's a cool perspective.
I'll give you just a perspective on that. I think that this is going to come across as being a little bit self-serving, but the reality is, in my experience, most people benefit greatly by having some kind of financial coach in their corner on these important issues. I see it time and time again that people have good intentions, but life is busy. And when you think about what a coach does, they basically, try to understand what your goals are financially, assess your current situation to see whether you're tracking in the direction of those goals. If you're not, then outlining some strategies and ideas that you could take advantage of to put you in the position of achieving those goals. And then on a regular basis, reviewing and assessing whether you're tracking in the right direction and revising the plan if there's been changes to your circumstances. So if you can do that on your own, awesome. But in my experience, most people do need that accountability and coaching. I'll give you a good example in estate planning. I was visiting Regina, where I'm from, and I spent some time with my mom, and my mom has constantly told me that, and she's given me a copy of her will, and she constantly tells me that she has the original signed will at home. And so we actually took a look at her estate plan recently, and I said, Mom, can I just take a look at your will? And she brought it out, and it was not the original signed will, it was a copy of the will. And I said, well, where is the original? And then she looked at the documentation, and it said it's vaulted with her lawyer. We found out that the law firm that did the will had merged with another law firm. We had trouble getting a hold of the lawyer that could give us some direction as to where that will is, and we're now in the process of trying to find that will. Now, if we can't find it, then we need to make sure that the law firm gets one drafted ASAP, that she gets down to the office and signs it. And she had thought for sure that she had the original will. So a rule of thumb in this area, make sure you're reviewing your estate planning documents every 5 years, or if there's been changes to your family circumstances. And family circumstances could be, marriage disruption, death of a partner, changing situations for your kids, health issues. Those should be all trigger points to just take a look at your estate plan.
Yeah, that's good advice. All right, well, do you want to move on to part 2?
Okay, what's part 2?
Theme. So, do you see any investment themes emerging out of the markets that clients and investors can take advantage of?
Yeah, the investment themes are not always clear, but certainly we're in an environment today where there's a very, very clear market signal. And that signal relates to the fact that interest rates have gone up quite dramatically over the last year. In fact, if you look at central bank intervention, whether it's the Fed in the States or the Bank of Canada or European central banks, we've never seen this much of a dramatic increase in rates in such a short period of time. It's extraordinary. And it's had, destabilizing effects on the economy and on people's pocketbook. Obviously, inflationary pressures hit people directly in terms of, filling up the tank, paying for groceries for families, servicing mortgage costs. Now, in spite of those hardships and challenges, the signal that the market's pointing to right now is this opportunity in the bond market. So we think about stocks and bonds, but a lot of people don't realize the bond market dwarfs the stock market in terms of total size. And although bonds are viewed as guaranteed investments, and they are in many ways, if I buy a Government of Canada bond, let's say it's a $10,000 bond maturing in the year 2030 and pays me a 4% interest rate, I'm guaranteed the 4%, I get my interest, I get my money back at maturity date 20 and 30, and that bond is backed by the Government of Canada, who have unlimited powers of taxation, and they print our money. So that's a pretty good guarantee. But tradable bonds like government securities, provincial bonds, municipal bonds, Crown Corporation debt, they're all traded and valued every single day. And they're valued relative to current interest rates. So a really good example is if you look at a bond that's paying 2%, and it wasn't that long ago that 10-year Government of Canada bonds were paying 2%, and now all of a sudden those same bonds you can purchase getting 4 or 5%, the bond market looks at those 2% bonds, which are not paying a great interest, and they have to value those bonds currently against 4% bonds. So what do you think happens to a bond that pays 2 relative to a bond that pays 4? Does anyone want the 2% bond? No. You'd have to sell that bond at a loss to unload it. So probably what you're going to do is hold it to maturity. So that's what we've come through this last year. Rates have gone up and existing bonds have traded downward. Now that we're in the situation where rates have gone up, rates have pretty much peaked. So now we're in the opposite side of that equation. We're going to see rates begin to come down over the next 1, 2, or 3 years. And it creates a wonderful opportunity in the bond market for investors. So we've been talking to clients about this opportunity, and if you're an investor looking to exploit an opportunity that's both conservative in terms of an asset class we can buy, but could provide some price appreciation, meaning I could get a 4% interest rate, but as the bond yields begin to come down over the next few years, that bond that's getting 4 will start trading at a premium.
Yeah.
So we'll get the interest rate plus some price appreciation, so it's sort of, we get our cake and eat it too. So it's a wonderful investment theme that people should be exploiting.
Yeah, that is very interesting. It's funny. So one of my courses I'm in right now is corporate finance theory and practice. And what we're doing right now is calculating cash flows, right? So taking in like taxes, inflation, all those different things, and like discounting it. So if we have cash flows of different years, bringing it back to present value, right? So it's funny that a lot of what we're doing right now is calculating what present value would be with different bonds and different stock options.
Yeah, so very applicable to this situation. So like I said, people don't think about bonds, but actually what I'll do is we'll put up on the screen right now an image. The image you see is basically what interest rates have done over the last year in this it's violent. It's violent how aggressively rates were increased. But like I said, we think rates have plateaued, and it creates a wonderful opportunity.
Yeah, that's cool. Financial tip for under 40s.
Financial tip for under 40. So we will be sure to, in this podcast, talk about that. So, our focus as a practice historically has been obviously helping clients prepare and transition into retirement. But it's really important to give good advice along the way to help people to be in a solid position financially when they want to retire. So that group under 40s, what should their focus be? For today's podcast, I'll just focus on one strategy, very simple, but it is the defining characteristic of people who are successful financially. Start it now.
Compounding.
So I've got many, many clients who have $2 million, $3 million portfolios. They started investing with us 25 years ago, 30 years ago. And one of the common characteristics of all those clients, and they're not necessarily wealthy people, but they manage their finances well. Obviously, they spend less than what they make, and they consistently saved money in their portfolios. So the most important thing is we're always going to have reasons why we can't start now. I've got a loan I want to pay off. I've got a trip I want to do. And what I would say to you is sit down with your financial advisor or contact us, map out a plan where at a minimum this is what you need to be doing from a long-term savings standpoint. So when you hit the age 55 or 60 or 65, if you just do that one thing, you'll know that you'll have sufficient capital to retire if that's something you want to do. Just do that, start that now. The second tip is don't be too cautious. Now, if I need money for my portfolio in the next year, you want to be conservative with that, or even the next 2 or 3 years. But if we're talking about someone who's in their 30s or 40s, on their RSP contributions, they may not be touching that for another 20 years. So don't be too cautious. Make sure you're participating in the markets. Yes, they can be volatile in the short term, but they'll give you the best payback in terms of return on your investment. So my clients have done well. They started relatively early. They were consistent with their savings, and they had balanced to growth portfolios. They participated in the stock market. So if you're patient, it'll end up working well for you.
Yeah, that's good advice. Well, one pretty fascinating article I came across when kind of doing a little bit of research for this was on AI applications in finance and kind of where the direction of AI use in finance. I know it's kind of changed the whole dynamic of school with different AI, like word generators and stuff.
Mm-hmm.
There's like cheating scandals every other week, right? But it can also be a really helpful tool, and some classes let you use it in forms of research for projects, right? Not in the actual writing of it. Where do you think that kind of fits into the financial services industry, and kind of how that could shake things up a little bit? Yeah,
I think it's a very topical question. You look at ChatGPT, and just it seems like it just all of a sudden it's here, and we're dealing with it. I'd say as it relates to investment solutions, different levels of AI have already been in place, and so portfolio managers are taking advantage of those platforms in terms of research and managing portfolios. But I do think that at the portfolio management level, AI will have a profound impact. You don't know for sure, but you get the sense when you look at where AI is going to go that it's going to replace probably a lot of jobs that typically have been in the purview of analysts and technical analysts, people who are gathering and aggregating research and peering through the research to come up with investment ideas. I think AI is a perfect solution. So if you're involved in that area, you're sort of going, okay, what can I do to stay relevant, because probably AI is going to make my job redundant. I think the other area is in financial planning. So the work that we do, we suspect that AI will more and more be able to take a client situation and run combinations, permutations of different scenarios around what they should be doing from a financial planning standpoint. So on first blush, you might go, well, then what's the role of the advisor? I think the advisor in that context plays an even more important role, because AI is not going to replace what advisors do, and that is to take the analysis and the recommendations and the research and then apply it in a holistic, human kind of way to the client circumstances. We talked about before, we're not robots as individuals. We're human beings, and we're driven by logic and emotion and circumstance, our relationships. And so the role that the financial coach will play is that that bridge between analysis, AI driven or assisted, with the client's circumstances, and to coach the client to make good decisions using the great information we can gather from AI. But AI is not going to replace the human dynamic, right? How do we help clients navigate volatile markets, uncertainty in terms of economics from time to time, and changing relationships and dynamics for their own personal lives? So I think AI could be a great tool for us as advisors. I think it's going to be allowing us to come up with sometimes counterintuitive solutions. We have a firm that we deal with that's developed some software. It's partially AI driven, and the only thing the software does is looks at deaccumulation strategies for retirees. And there's some rules of thumb in our industry about that. And then when you run this AI tool, it comes up with scenarios that are counterintuitive. They're a little bit surprising. So there's real power there, but it's never going to replace the individual who is working with clients, helping to make sense of the information, and then helping them to implement the information in their circumstance.
Yeah. No, I think, and I kind of relating back to the whole, what we started with, and like how people believe one thing and they want to do one thing, and actually making it happen. And I think there's definitely a role for someone there to kind of push them towards like, okay, well, this is what we got to do. Let's do it, right?
Yeah.
And you could have all the answers, but a lot of times just put things off, right?
Exactly. I think that aspect of human nature is never going to change.
Yeah. One of the biggest things here, kind of moving forward, is we had talked about questions, right?
Yeah.
And we want to kind of a part of this to be questions that people send in that kind of we can talk about here, right? And give a perspective. And it might be an easier way for people to get more casual questions in.
Yeah. So in the show notes for this this podcast video, you'll find a link back to our website, and so don't hesitate to zip us a note through our website on questions that you'd like to see addressed in future podcasts. So I think that's one way that we can aggregate some of those questions. So yeah, please feel free to do that.
Yeah, awesome.
Well, thanks so much, everyone, for taking in our podcast today. We're really excited about this initiative. We'll continue to refine the contents, and so on a regular basis, like I said, we'll have a financial planning topic, a tip for the under 40s group, make it major market or investment themes that are emerging in capital markets, and then we'll aggregate questions that come up and add those to our agenda. So thanks so much, Josh.
Thanks for having me. It's been a pleasure.